Chapter 2, don't get sucked into the widow's tax trap. If you are married filing jointly MFJ taxpayer, you will not be one indefinitely. At some point, you or your spouse will be a single taxpayer, and your situation will change dramatically. Let's go back to John and Judy. Their income is $100,000, which consists of John's military pension and IRA distributions. That's it. They have a $45,000 IRA distribution. John has a military pension of $55,000. Their adjusted gross income then is $100,000. Again, we have their standard deduction, $26,600. Taxable income then is $73,400, which means their tax due, as we talked about in the previous chapter, is $84,26. Now, let's say John dies. Thankfully, he filed for a 55% survivor benefit pension when he separated from the military, which allows Judy to receive a pension benefit of $30,250. However, that's not enough for Judy to live on. She feels she needs a gross income of $75,000 to maintain her lifestyle. So the rest of her income will have to come from IRA distributions. After all, she's not working. And in case you're wondering about Social Security, don't worry, we will get into that later, and that's what really gets fun. Now, what happens when Judy goes to file her taxes? She has a pension of $30,250. She has IRA distribution of $44,750, which gives her the AGI, adjusted gross income, of $75,000. But she only now has one standard deduction, whereas before they had the $26,600 in standard deductions. Now she only has a $13,300, which means her taxable income is $61,700. And her tax due is $9,513, my friend. So let me go back. When John and Judy when John was alive and they're married filing jointly, they had taxable income of $73,400 after standard deductions. Now Judy is alone; she's a widow. She has taxable income of $61,700. That is taxable income of $12,000 less, essentially, than they did John and Judy. But she pays $9,500 in taxes, where John and Judy only paid $8,400. She pays $1,100 more in taxes. Now, Judy has a 33% less income, but yet pays 13% more in federal tax. That, my friends, is the widow's tax trap. How can this be? Well, notice that a single taxpayer is in the 22% tax bracket when taxable income exceeds $38,700. A married couple, though, must have $77,400 of taxable income before they are in the 22% tax bracket. On top of that, the married couple gets the two standard deductions. Again, it's $26,600 for John and Judy, where Judy only gets the one. So not only does less income put her in a higher tax bracket, again, a single taxpayer, $38,700 or more puts you in the 22% tax bracket, but she can only write off $13,300, whereas a married couple has two standard deductions and they need to have $77,400 before they're in the 22% tax bracket. Higher tax rate plus less standard deduction equals much more tax. And there you have the widow's tax trap. Less income and more tax. Now, this is a book about the Roth IRA. So if Judy had the Roth IRA distributions instead of traditional IRA, you want to take a guess what her tax would be? $1,800, $1,844. Why? Because we have a pension of $30,250. We have a Roth IRA distribution of $44,750, which means we have adjusted gross income of $30,250, because that $44,000 Roth distribution does not included in taxes or an adjusted gross income. It obviously doesn't fall into the taxable income line as well. So she has adjusted gross of $30,250. She has a standard deduction of $13,300. Her taxable income in this case is $16,950, and that puts her at a tax due of $1,844. That's it. So the question needs to come out. She paid $9,500 before in tax. Now she's paying $1,844. So roughly, we'll say $8,000 less, give or take, or $7,000 less, give or take. Each year, don't forget, when they put the money into the Roth, it was a one-time deal. $7,000 more in taxes today and every year hence versus whatever the tax was on the Roth when they initially put it in. Now, it doesn't stop there. In the next chapter, we're going to bring in Social Security, and we're going to see it gets even worse as well. So stay with me.